Have you seen Deepest Breath?
No.
It's about freedivers. You'd love it.
Oh,
It's so good.
So this is really interesting.
It's hectic, but it's good.
I want to talk about this because they get asked a lot about their approach to sport and their strategy in sport, because everybody wants them to sort of become an ESPN and do live sports. But and I asked them this specifically, like what they've done to Formula One with Drive to Survive is phenomenal.
In the
US, in the US, nobody watched it, and now they've got 3, maybe 4 Grand Prix that are happening in the US, and then similarly they've done a similar thing with cycling, and they've also done the quarterback as well, which is
the quarterbacks. It's on the list, isn't it?
One. Yeah. So there's a lovely quote. So they say, "We're not anti-sports. We're just pro-profit." Right, and this flies back to when I used to cover Sky, which is that when these sports rights are up for renewal, the price always goes up, and you don't own the rights, you just rent the rights, right? And so it's very hard, ask Disney about this, with ESPN, to make money out of sports rights. The real people that, I think I wrote a note once that said, Liverpool house prices and Manchester house prices do particularly well because all the players, they're the ones that benefit from all of this, not the Sky shareholders. Yeah, Bentley car dealers, exactly right. So so that's interesting. And then finally from LA, we went up to Seattle and saw Microsoft and T-Mobile and of course Amazon as well.
So LA, San Fran, you were in Eastbourne last week, presumably. I like Eastbourne.
Yeah, where was I last? I can't remember where I was last week. No, Kent somewhere. No, Essex last week.
Doing the rounds.
The glamour.
No, it is the glamour.
It's the glamour. It's the best part of the job. Getting out and seeing people. Exactly right. I could talk to the Cows Come Home about this. So before I do, I'm going to introduce the show. Welcome everyone. Taking stock after the bell. Mr. Ben Barringer this week, not only an executive director at Quilter Cheviot, but one of our senior researchers on the team, covering global technology, media and telecoms. For my money, one of the people with the most interesting jobs in the firm, as you've probably heard about. I could talk to the Cows Come Home about the sport thing. I think what they've done with Drive to Survive is super clever because you've got a narrative around people that you wouldn't necessarily know that much about. The drivers, and that's kind of the format that they're going with so far. But I think you can see this with Sky. Sky are pouring a huge amount of money into the Football League from next year because I just think top level, well, football's the obvious one, is just becoming so expensive to get the rights to. And actually you can get more of the top level football is so inaccessible. There's not really a narrative around it, whereas they can spin more of a story for slightly cheaper, I think, with the lower ends.
Human beings love stories, don't they? That's what we...
Yeah, I mean, this is going back to what I was saying about Netflix and them being, television. When I was young, sound like an old man.
Sorry,
there was Anglia and Granada and Thames Television, and television was local. And then it went to national because that's just not economic, and now it's global, right? And Netflix say this a lot. It's all about global storytelling. Squid Game is a very Korean story, but it's a story that resonates with lots and lots of people, right? And so, that's what's happening. And the same is true with sport. There are great stories that happen within sport. That's why we're so obsessed with it. And arguably, those stories don't need to be live.
I actively think they don't want them to be live anymore because you can curate your content. Plus, people don't. It's depressing to say. People don't want to watch 90 minutes of football anymore. Young people don't want to watch 90 minutes of football anymore. They'll watch 5-minute highlight reels of whatever it happens to be. So,
I'm not a soccer fan.
No,
and I use that word deliberately.
Well, any sport that goes on, how many people are watching full days of golf? No, young people that don't really do it.
It's not engaging, is it?
Sure.
And if you're Netflix, you probably want snappy narratives and
again,
stories.
Full Swing from Netflix. Great show. Just basically showing that pretty much all players are equal. It's just confidence that makes that last 0.5%.
Well, get to know the people behind the game. I'd like to. Can we kick off with Netflix actually? Because something that really interests me about the stock market in general is narratives, and I wrote something this morning about this. You can have a narrative around a company, and very little changes about the company, but how people feel about the company oscillates wildly. And I've got, if I sit in front of a customer for the first time and explain to them what the stock market is, you are buying a right to the earnings of the best companies in the world, and how people feel about those earnings will oscillate wildly, but over time those earnings tend to go up. So how, as an analyst, do you sort of separate yourself, I suppose, from the prevailing narrative? And Netflix is one that's come a long way in 12 months.
Funnily enough, I was thinking about exactly this question this morning, because what drives share prices you can decompose into two things, right? The earnings of the company, and then the multiple that they put those earnings on, and what drives the things that drive that multiple. It's quite a long list, right? And so it's, what's the growth of the company going to be? What do the earnings look like in the future, and how high quality is that business, and what's the discount rate that you use for all of that? So and what is the sentiment generally towards those? To your question, what is the sentiment? And you're right, Netflix has had exactly that roller coaster ride as people. Because you're discounting a long way into the future, right? You're trying to say, what does Netflix, with every investment, you're really trying to say, what does this look like in 5 years' time? Let's pick that as a horizon. The business was at conception. There's a famous quote, like, I'm about. I think it was a Time Warner CEO said, I'm about as scared of Netflix as I am of the Albanian army, right? And that guy, and that guy no longer works for Time Warner, and Netflix are clearly where they are. And so
Netflix started out flocking DVDs, didn't they, in the post?
Absolutely. In fact, last quarter they shipped one of their last DVDs.
Did they? You still have that business?
So that business still
presumably
exists.
That's just one bloke in a warehouse every 10 minutes putting a DVD.
That's right.
Yeah.
It's a very small part of my model, So we went on this narrative of how many households are there in the world, and how many can they accumulate, and then what does profitability of a business that's never existed before look like in 5 years' time, right? Which is subs times price minus costs, and 80% of their costs are content, right? And so that's great when everything's growing, but then their stubs started to slow, right? And and let's face it, they had the absolute, like lots of companies during COVID, they had the absolute golden moment. Like, if you weren't going to watch Netflix during COVID, then you were probably there was something wrong with you, or you had very good reasons why you didn't. So it was a golden time for them. They then faced very difficult comparisons as well, and their
costs went up as well,
and their costs went up as well for lots of different reasons. And it's also a very difficult business to forecast. Like, they always put out quarterly guidance, but they don't know any more than we do, really. You know that you're going to get more subscribers in the winter because people watch more TV in the winter, but they skew their slate for that, right? So anyway, so looking back, they slowed, but then they realised that they'd really got some things up their sleeve, right? And we all knew that we had an account, but it was shared with my parents or my brother.
Yeah, if Karen Henry's watching this, you're going to have to get your own account or a freeloader.
so there's a whole load of people password sharing, and then there's also one of the original conceptions of Netflix was it was a great product with great TV, but with no adverts, right? And they realised that, and I don't think they particularly wanted to do this actually, because I think they wanted to create an ad-free business. But the pressure that the share price came under, they pivoted and started offering ad-supported. And it turns out that ad-supported, you can make an awful lot more money than you can, from a subscription.
Why is that?
Basically, because
our eyeballs are worth more than
we think they are,
and that we're willing to pay on a monthly basis.
Correct. So typically their typical ARPU is $10 a month, but they are going to sell ad supported for sort of $6.99, something like that, so $7.
Yeah.
But they think they can make $5, maybe $6, maybe even more of an incremental ARPU. So rather than going from 10, you're going to 12 or 13.
So they make $5 a month in advertising.
That's right. That's right. I mean, it's very interesting. There are services where you can get a ad supported, or you can get a non-ad supported, and it's and they're identical services, and you can price how much you think advertising is worth to you. Some people, myself, I would pay an extra $5 not to have advertising.
Same.
personally.
But we're not the demographic, are we?
And that's particularly important when you go into a macro slowdown, right? Because people are looking at ways of cutting costs, even $5 a month. And so it plays to that, and it opens up another demographic. So, sorry, not a demographic, but another pool
option.
Of people.
Don't churn off completely. Just go to the cheaper version.
And or people who couldn't afford Netflix or.
Just as sort of a segue, as an aside, one of the sort of themes on this podcast has been: are we going to have a recession? Yes or no?
Mm-hmm.
And I joined 10 years ago when obviously you covered Sky, which is no longer a UK listed business. And I do distinctly remember you saying pretty much every quarter, whenever we were worrying about recession, Sky is a recession-proof business.
Completely.
People do not cancel their TV.
Pre-Netflix
Sky. I mean, people are not going to go out on holiday or to restaurants.
TV is incredibly cheap entertainment. Was it cost £7, if say it's £10 a month? That's very cheap. I mean, it's a bit like your telecoms bill, your mobile phone bill. It's very cheap considering the amount of value it gives you.
So if there's I remember thinking this myself 6 months ago. If there's a mega ugly recession, are people going to get rid of Netflix? Was probably one of the last things to go. I think this time around, Sky could be toward. I think about my own circumstances. Do I want to pay 120 quid for Sky if I lost my job? Probably not. I don't really want to watch United that badly. But that's probably a wee bit more exposed than.
Yeah.
What I do think will happen though, people, as this sort of plethora of other services becomes available, sort of HBO Max and Disney Plus clearly, and obviously Amazon Prime as well, is people will be a bit more selective. But the great thing about Netflix is, one, they don't have a legacy business, so they don't have to worry about traditional advertising, a bit like unlike Disney. And then they have just got a better content slate, right? They're absolute experts at making sure that it goes a little bit quiet over summer, but then they can ramp stuff into the fall, into the weather. That's right.
So we had numbers last week, Ben, and the stock was down. The numbers were actually, subscribers were better than they expected, but obviously, who knows what to expect each quarter. But is that a function of the stock is already up 50% year to date, and therefore being down 5 is not a big deal?
I think that's right, and I think there's a little bit of that happening in lots of companies we've seen report so far. So we've had ASML, TSMC, Netflix, and all of them have been okay, but they've not beaten whisper numbers or buy side numbers. In tech, you get the sell side published numbers, then you get sort of buy side which aren't published, but they can often vary, and then you get whisper numbers closer to the print, and they didn't smash it, right? And they're being very slow and deliberate about this advertising rollout. It's not just a switch you can turn on.
Yep.
And similarly with the password sharing, they're being very slow and deliberate about that as well, because you're creating a churn event for people. It wasn't publicized as a benefit of having Netflix, but being able to share it has become it is a thing, right? It's not probably not in the terms and conditions, but they're just tightening that net, and that's why we stayed positive on Netflix despite the sort of fall off in the share price. Because I always think about a business in terms of levers of growth and how many levers have they got to pull. And Netflix had quite a lot of levers, even if things were going bad for them. Sometimes you run out of levers as a business, and that is a problem.
Yeah, they've got the scale like quite a lot of these companies, which we'll get onto in a minute. Sure. But in terms of streaming, had a real moment in time there, and sometimes the stock market, and I'm sure you deal with these companies, so you know much better than me. The stock market kind of tells you what you want from a business, and Netflix at $700 a pop. Wasn't it? Stratospheric rise. All of a sudden, everyone needs to do streaming. What do you think happens in streaming? Because there are a hell of a lot more players than there were 3 or 4 years ago, and it turns out streaming is a really difficult business. If you look at the numbers for quite a lot of these.
Yeah. Look. So really, all you've done is turn it from being delivered by aerials to being actually delivered through the internet, right? With the fact that Netflix was very differentiated in the sense it was completely ad-free, and it was a utopia in the sense that you could just watch TV and nothing else, right? That's now changed, and everybody is moving to advertising type models. So really the only thing that has changed has been the delivery mechanism and just the scale that one can achieve, right?
Yeah.
And so, everyone's going to move to that model. It's my belief that only the big guys survive, right? Because you need to have that content slate. And Disney, even the mighty Disney, is struggling with this, because if you think about Disney Plus,
they've got the best content slate in the world, probably.
It's high quality, but it's quite niche. Like, I cannot get rid of Disney Plus because my daughter loves Frozen, right?
Yeah,
so I'm hamstrung. But plenty of people don't need to watch Disney animation, and they don't need to watch the Marvel stuff, and they don't need to watch the Star Wars stuff. And so there is a little bit of fatigue with that. So there's not that very wide general entertainment that Disney's got, and that's why they bought some of the Fox assets. You remember?
Tried to buy Sky.
ESPN,
they
I think
tried to
they
buy
have
Sky
as well, don't they?
Then they own ESPN. And go back to my previous comment. That is a difficult asset to own because the economics of it are not very good. They also own the IPL in India, but again, they got sort of outbid on that, and the economics didn't make any sense. So, Disney is not well set up, because you've got Disney Plus that's not delivering. You've got difficult comps in terms of losing the IPL. You've also, in the recent traditional television advertising, they have this thing called the upfronts, right, which is where advertisers commit to this year's worth of advertising, and the pricing that you get off that is normally what dictates pricing for the rest of the year.
Yes.
The upfront pricing. Eyeballs in linear TV, we all know, have been declining for 10 years, but because that audience was still quite big, and to get to it was a sort of increasingly difficult. The pricing in the upfronts has always been quite positive, right? And so if you look at Disney's linear TV business, it's been stable, not declining. This most recent round of upfronts, pricing has started to fall off as well. So you've got volumes going down and pricing going down. And that's not a good look, right? So
Disney should buy a cinema chain.
Well, again, it's got its own problem, because during COVID, it played around with all of those windows, right? There's a window system, right? You release stuff in cinemas, and then you release it on television and selected movie channels, and then you release it on DVD and so on and so forth, all the way down, right? And lots of those channels have collapsed because of COVID and people wanting the to your original point, everyone's drive to go towards streaming.
Yeah. I mean, cinema's a dying business, isn't it? I can't remember the last time I went.
I think so. I think it's had a bit of
a
renaissance, just because, like a lot of outdoor activities and special treats,
you can do it again.
You can do it again. Right. Yeah, exactly. Right. And then you've got their parks business, which is a phenomenal asset. And Disney's 100 years old this year, and Disney will definitely be 100 years. Exist in another 100 years and have great appeal. But again, you're coming off difficult comps as well. So it's a more difficult setup for Disney into the quarter. The one I'm most worried about, I have to say.
I think I've said this to you before, John. I heard on podcasts the highest margin that Disney sell is the chicken tenders at their amusement parks. So
no, I've not had the pleasure.
Mickey Mouse, Donald Duck, and they're basically flogging chicken strips, right? That's what they want you to buy.
With a 4-year-old and 2-year-old, a bit like you, Ben, I'm guessing it's just kind of a matter of time before I get the opportunity to sample them.
It's not in my cash flow spreadsheet, but it's probably going to.
Yeah, that's a big old liability, guys. It's coming.
I mean, those guys are just a machine at sort of emptying your pocket, basically.
Yeah, 100%. Wow, good for them.
Want to jump the queue? Yeah, no problem. We can pay for that.
It's everything. Everything's got a price. Just money making. You talk about pricing power, and that is example 101. Year to date so far, Ben, in terms of the market, so what you can see here on screen, which is I think a neat little chart, is basically the top 10 stocks and the contribution to total return. For the American market, the S&P 500 from the beginning of the year to 31st May on the left hand side, and basically all of the return of the market during that period's come from the big 10, if you like. Since then, broadened out a bit,
yes.
Which is what we were talking about a couple of weeks ago. What tends to happen is the rest of the market catches up, because the narrative tends to be all the performance is coming from 8 names.
Yeah,
market's going to collapse. Historically, that just hasn't been the case. But just coming over the left hand side here, if you haven't had Apple, you haven't had Microsoft, Nvidia, Alphabet, like you've been kicking uphill, right?
Yeah, I mean, look, it's been difficult because we got this right coming into the year. Like, we thought that the fundamentals for tech were well discounted this year, and actually 2024's you're going to get decent growth from tech. In fact, better than any sector in 2024. So you've got reasonable fundamentals that are well discounted. You've got relative growth that's looking pretty good. During the relative growth, exactly. During 2022. It was much easier to get growth in oils or financials and so forth, and energy generally. But that's rolled over. And then, interest rates are starting to roll over as well, right? And so the long duration nature of some of these companies. But the characteristics of these companies that we've got up here these are not the super fast growth companies.
No.
These are generally the mega caps, right? And so they've got great business models. They're all profitable. They've got cash on the balance sheet. They've got very high return on invested capital. And some of them have had earnings upgrades because of things like AI. So, Microsoft and Nvidia are probably the most obvious examples. Apple is more puzzling. Apple is a very difficult one because it should have a great AI strategy. Siri should be a much better product than it is. Right?
Do you think it's rubbish?
I think.
Sorry, not to put words in your mouth. I barely use it.
Poor, extremely poor.
It's unusually bad for Apple.
Yeah, I think because again maybe they haven't invested in it, but maybe with AI you get some of these hallucinations and you get perfect results. And I think Apple's strive to be perfect is a little bit at odds with some of the stuff that current AI produces, right? So maybe it's that, or maybe they just haven't sort of doubled down and focused. There is chat that they're going to improve it. Generally, I think the best explanation is one, the buyback, because it's a huge buyback, and it's a bit like a python eating its own tail. You know what I mean? It's this sort of perpetual motion machine of being able to produce cash and then buy back stock. And so
the market cap's about 3 trillion, isn't it?
Yes,
which is more than the FTSE 100, which we've mentioned numerous times
every week.
Absolutely.
What is the buyback?
I forget the numbers. Yes, it's a couple $100 billion.
It's half of Berkshire Hathaway stock portfolio now.
Yeah. The other thing is that classically, Apple always performs quite well into an iPhone launch as well. So it always does quite well in the 3-4 months before September when they relaunch. But this has been, as your chart shows, this has been running for 7 months. So it's been very strong.
Apple was one of the better performers because most of these stocks here on the left that have done really well for the first few months of the year had a really bad year last year. Right? So Nvidia, Tesla, Meta, they're all in 70% drawdowns. Amazon, Google were nearly 50, weren't they? Apple was probably the best of those, right?
Yeah.
Down 20-25 or something.
It's really difficult because we might have talked about this before, but you can view Apple two ways. It's either a hardware company that sells technology, or it's a brand, a luxury brand like Nike, right? And so the 30 times or 29 times it trades on today should either be compared to a PC manufacturer or it should be compared to Nike, right? Which is on 32, I think, something like that, right? So that's the issue. The other thing that worries me a little bit about Apple is they've released their Vision Pro, their sort of metaverse goggles, and so far shipments have been below what people have been expecting.
What's the pricing in those?
They're $3,000.
$3,000.
Yeah,
okay.
It's a bit more than $3,000.
Luxury brand company.
Yeah, I mean, it's a phenomenal bit of technology, but it's not. Compare it to Meta's Quest. It's not, 2 or 3 times better. It's just, Apple again wants to make the perfect product and sort of assess the market. Maybe we'll get a sort of not a dumbing down, but a specking down of the product if it's successful. But so far, it's it's absolutely, again, a very small part of my spreadsheet, my valuation.
Yeah, sure.
The second point is that Apple's been sort of defying gravity in terms of compared to other smartphone makers. So Samsung and all of the other Android players have been in decline for most of the last few years, and Apple's been outperforming and taking share. But you saw in those TSMC numbers that smartphone was down 9% last quarter, and Apple is TSMC's biggest customer, right? And so there's got to be some read through into what Apple units are doing.
This is, I think, this is a really interesting point, because we haven't been through a recession, a proper long protracted recession, in 15 years. When was the iPhone brought out?
Around
07.
Yeah.
07.
So just before the last sort of extended recession. We don't know how much pricing power they have.
Well, it's very easy to. So when if you go through an iPhone replacement cycle, historically it was because the battery stopped working after a year or two. But actually,
I can't believe they get away with that.
They've improved it now. So I've had my phone for 2 years and the battery life is still brilliant, like very good. So with the replacement cost being £1,000 or £1,200 in the UK or whatever it might be for the top model, it's very easy for me to say, well, actually, I've had my phone 2 years, I'll just keep another year. So in terms of coming back to the recession point, if you're facing recession and a bit of belt tightening going on and there's some potential job losses around you, unlike your Netflix subscription, it's very easy to just postpone changing your iPhone unless you're a diehard. So I think you're absolutely right. I think we haven't really had a proper recession to test Apple in the world of $1,000 iPhones.
Then it's your point, Ben, what sort of metrics is the market looking for? It's not necessarily iPhone sales anymore, is it? It's,
well, then they don't report units anymore. They only report sales, right? So they can just,
because that's what everyone used to focus on.
Yeah, that's right. Yeah,
and takes the eye.
In fact, Netflix now do the same as well. They focus on revenues, not subs. So it's an admission that they want people to look at the pricing power that they've basically got. The only thing I would say as a counter, and I'm sort of arguing against myself, is that just think in your Maslow hierarchy of needs.
Very high.
Yeah, the iPhone is essential, right? I had to go and I had a problem with my phone.
Before you start, I've got to know, because you're the tech guy. If you got an iPhone, are you an iPhone man?
Of course, yeah.
Okay,
yeah.
right.
It's actually, I don't have all the Apple products, but in fact, I had a problem with my 14 and I upgraded to the 14 Pro because the camera is that much better, right?
Can you tell me then why they make the phones so big? The phones are too big.
They've stopped making the smaller one. I have a friend of mine who has the last one they made. Is it called the Mini?
5S or something?
No, not the 5S. There was a mini one, and he just liked that because the screen was too big. Why they're so big? Probably so they can get enough chips and battery in it to make it last long enough.
Yeah,
that's probably the reason.
There you go.
But yeah, I went through I don't know if anyone's done this, but they do a complete profile refresh and you basically delete your iPhone, right? And hope that you can restore it into the same way. And I've never had a heart transplant, but I can imagine
felt like that.
Pretty close, and I'm a tech guy and I was in the Apple store and I'm like, you're going to help me through this, because if it goes bad,
I know.
I'm gonna cry.
Yeah, I'm gonna cry. Yeah, undoubtedly.
Yeah.
It's an unbelievable company, and as we've said, there's a bunch of different ways of looking at it. Tech as a sector, I think, is probably, again, don't want to put words into your mouth, but probably a much harder sector to try and model, because a lot of these companies are out here, like the growth and the ideas, and that's out here.
Yeah.
It's not a company that's going to go between a 9 times price to earnings multiple to 6 times and back again.
No.
A lot of the growth is,
yeah.
How do you think? I mean, there's got to be quite a lot of estimates, guesswork, but you know what I'm driving at. Qualitative work with these businesses.
Yeah, there's quite a lot of qualitative stuff. I mean, ultimately, all of this sort of, I remember through last year and the last couple of years, there's been this sort of risk on, risk off. And I sort of think of that as how far people are prepared to discount the future. It was 2021, people were sort of, and money was free. People were like, well, yeah, that's 10
dreams.
years.
We want dreams.
Absolutely. We don't care about profitability. We only want growth, right? And the rise in interest rates has really meant that money is no longer free, and so a hurdle rate exists rather than there being no hurdle rate. It always used to make me laugh. Like, we've bought this company and it's accretive to our profitability. If you can borrow
in
nothing,
in 6 decades time,
of course it's accretive, right? And so yeah, now there's a little bit more of a rationalization, and I've always tried to model, even when I was modeling Netflix or Amazon, back when Amazon, what was that, 2013, when Amazon was $300, so what's that, 10x less than it was. you have to be able to see a clear path to profitability, and then you start to look at other businesses and say, what would a margin look like when it hits profitability? So in the case of Netflix, what does a television network, what's that profitability? And actually the number is about 35%. I model Netflix getting to 25% margins over the long term. Similarly, Amazon, what does a large scale retailer make in terms of margins? Now their North American margin hovers around sort of 5%. I model 8% in the sort of longer term. So you have to have just a view on profitability. But yeah, it involves taking an intelligent estimate.
Yeah,
you could use the word guess as well, but I think estimate is sounds.
It's just there's quite a lot of variability. I mean, something like an Alphabet. I mean, they spend a huge amount of money on research and development, don't they? So there potentially could be some businesses cooking in there that are
sure. All of these big tech companies, that's one of the reasons they keep all this cash on the balance sheet. It's typically 10% of the market cap of the company, is because they've all read the books about disruption, right? And they know that it's very rare that the winner in one cycle is able to hop across the chasm to the next cycle, right? Microsoft is probably the only example of that in recent history. Intel, Xerox, you Blockbuster, you pick your
I think it was Bill
previous
Gates.
dinosaur.
I remember reading a Bill Gates quote. He said actually innovative technology should probably trade in a discount because of that very potential that you get disrupted, which is kind of in some ways counterintuitive.
I mean, it used to happen a lot in cybersecurity, not as much anymore, but you get guys that would build a company, and then the sort of core team would build the company. It would hit sort of the growth at the top of the growth curve, and then the sort of core people inside it would go off and set up a new company, right? So that innovation is always going to happen because people are always looking to reinvent stuff. One of the key reasons in tech is because as soon as you start a business anywhere in the world, right, the tech you've chosen from day one becomes legacy, right? Because you've made a decision. So unless you can be very, very active in terms of keeping your tech footprint and on the tech you use up to date and evolved and so on, you have legacy when you start a business. And so that's it, and it happens more actively in tech.
There's a couple of charts here. I think you sent across, Ben, beforehand, referred to the haves and haves nots. Here's what I think's going on here. I think tech, mega cap tech, where the performance for the first 5 months of the year has come from, are ports in a storm.
Yeah,
I think people are buying them because they can say with a degree of confidence Microsoft is going to grow by 20% next year or X% the next year. And these, this chart is quite a busy chart, but basically it tells you that these are unbelievably good businesses. And what we have seen historically, this is JP Morgan from the latest guide to the markets, quality tends to outperform in a recession. So S&P quality relative to the rest of the market. So if you're looking for a business going into a recession, a mega cap with scale, with unbelievable profitability, with levers to pull, not a bad option.
We used to use this term TINA for equities, right? There is no alternative. But when I think about it on a cross-sector basis, it was the default place to put money, large cap tech. Not unprofitable. You notice back on that slide that one of the quality scores for high growth tech was actually quite low, but that's because of the lack of profitability.
You sent this chart as well, which caught my eye, which is the share of technology, isn't it, in unprofitable businesses?
Right on.
I'm pretty surprised that's not gone a lot lower recently.
Well, this is what's been happening in probably the last 3 or 4 quarters. Businesses have been asked by investors, can you pivot from growth to profitability? Right? There's this horrible thing used in software analysis called the rule of 40, which basically, if you add up the sales growth and the margin, you get to 40. Like why 40? I've no clue, and that's why I don't like it as a metric, because it's just a random number. But it as your growth slows, you should be able to increase your margin, right? Look at big companies like Salesforce, which was Mark Benioff has been driving since he set up the business. Growth. Phenomenal perks for staff, DJs in the lobby, incredible customer conferences with Metallica headlining, and a combination of rates going higher and pressure in the form of activists, sat on his lawn saying, hey, you are a massive software company, your margins are 15, 16, 17, something like that, and Adobe's are 40. Come on, what gives, right? Yeah. And so they're on a target for exactly that pivot.
Yeah, Metallica aren't free, mate.
No, absolutely. They had Matthew McConaughey do some internal marketing, and he charged them only, I think was it $1 million or 10 million? So it was a big number. So yes, everything is a little bit gold plated. If you worked at Salesforce, that is changing. They no longer. We met them in San Francisco. They don't have the DJ in the lobby. There's cost cutting for you.
That comes back to the point about rates. When rates are naught, get the DJ in, grow the top line as aggressively as possible. Don't care about your profits. And now all of a sudden, interest rates are 5% and US 10-year treasuries are 4%. Right. Investors are going, right, well, it's time to make us some profits.
Got the memo pretty quickly. I mean, it's the point. They've got levers to pull, right? Yeah. So if you're one of these unprofitable businesses that's based on dreams and jam in 30 years, you haven't.
Well, that's the point about the year to date, isn't it? So during the pandemic or the post-pandemic boom, as we call it, sort of mini bubble that we had, it was all the unprofitable stuff, wasn't it? The Zooms and the Pelotons and the the really like wacky stuff, Rivian and kind of all those things. But the year to date, those unprofitable things, those dream stocks haven't come back.
No, they haven't.
Whereas the ones that have pulled the levers.
Correct.
And last year we were all talking about Microsoft laying off 10,000 people, Uber going for free cash flow positive, CRM, Salesforce going for margin accretion. Completely. That's the story because the world has changed. We're no longer in that kind of 0% interest rate world.
The tech CEO. One of the things that's also, we haven't really talked about this, but these companies have great managements that are able to pivot trillion-dollar businesses pretty effectively. Zuckerberg. Laid off a load of people, and maybe we'll come to that. But all of these companies have had layoffs, and that is amazing because there are plenty of smaller companies that can't pivot that quickly.
No. Why is that, do you think?
I think they run their businesses based on data. They are very. They're very scared of disruption. And they're also very wealthy, so they haven't got a huge amount to lose. But they really want to deliver and evolve their businesses quickly.
Is that because they've been disruptors historically?
I think so.
They realise they need to keep doing that, and that's embedded into the management culture.
Yeah. What's that famous Intel book of CEO? Only the paranoid survive. Right, and it's absolutely right. I think there is just this culture of change.
But you're right. I mean, Microsoft have done it. Netflix, to a degree, have done it. Yeah. Salesforce are doing it. Uber, one of the good examples from last year, was Travis Kalanick. Yeah. He's no longer in charge. And Meta. This is amazing, isn't it?
That's a good book. Actually, super pumped about Uber. I think they paid Beyonce in stock to do one of their company gigs. They got the memo pretty quickly on profitability, right? But
there's plenty of companies that haven't done that pivot and haven't been rewarded by investors. We haven't talked about SPACs. Remember those? There was an indicator.
What was the you're bound to have seen? I always try to think back because a couple of years is a very long time. Was there a peak moment where it was like, this is a bit out of hand? I mean, GameStop sort of jumps to mind.
Yeah, I think SPACs was pretty much. SPACs was sort of the belief that there's this loads of companies that VCs are. I mean, I've got friends who are VCs, and the skill set. I'm CFA, but their VC sort of history. Our skill sets are very different, and the way we look at things are very different. There are similarities, sure, but the way that we think about the world, and I think SPACs was an attempt to move things faster through the IPO process, or completely get rid of that.
Because you didn't have to give projections, right?
No, absolutely. And you would, there was a whole, I don't know what the stats are. I think I heard that sort of 1 in 20 of the companies that came through a SPAC process are higher than they were when they IPO'd, right? So it's and 1 in 20 is, that's a VC,
I think that's
that's a VC track record,
yes.
right? So that's back to my point, right? Which is that they just weren't ready. Those companies just weren't ready, and it was just like, what can we find that's growing? Okay, yeah, whack, we'll stick it through.
You're incentivized to do any deal, aren't you? As a SPAC, you're incentivized to do a deal.
Sure, of course.
And if there's loads of competition, you're not going to be left with arguably maybe all the best businesses. But
I think that's right. I think there's been a huge amount of pull forward. I pity, I don't pity investment bankers who do IPOs at the moment, but there's been a huge pull forward of those businesses.
Are we seeing, in terms of initial offerings, are we seeing like a revival there? Is there not much happening?
No.
Deadsville?
Yeah, I think so.
Yeah. How long does typically?
I met a UK company and that I've loaned for sort of almost 10 years now, and the CEO, she asked me, should I IPO now? And I said, absolutely not, because but this was 6 months and maybe 9 months ago, because there's just not a solid market. Maybe once the macro starts to improve and rates get a bit more stable, but I think people are much happier holding relics than they are, a new IPO. And also when you've been in a bear market, people just don't have the time or bandwidth for new ideas. I don't think. Would be my 2 penny worth.
If you've got a good AI story, you can probably get it away in the US at a decent valuation, probably.
Johnny hates tech stocks. If it's not a 2-year gilt, Johnny's not interested.
Have you heard about the 2025 gilt?
It's
to a high rate taxpayer, you say?
To a high rate taxpayer, precisely.
Yeah.
The old favourite at the minute.
I must say, I own a short dated gilt in my PA portfolio as well.
Roll up.
So there you go.
You feeling all right?
Even the tech guy has a 2-year gilt.
We had a macro guy in, didn't we, from one of the big investment banks, who shall remain nameless, and he's well known, very good, been following him for years. He's not a lot older than we are, late 40s. And he said that he just bought a gilt for the first time in his life. Goodness me, what is the world?
I've basically spent my entire career, with gilt yields under 1%.
Yeah. Sure.
So, I mean, this in some ways is pretty exciting.
It's accentuated by the fact that the banks aren't delivering similar returns, right? So it is I can get that, but you have to go down a specific route. But I know what you mean. Do you want me to? Should we talk about this V-shaped recovery?
Yeah. So Meta is one that I really wanted to talk to you about, because it sort of brings the conversation full circle. Because we're talking about shifting narratives. You couldn't give this thing away last year.
Sure, below $100. Yeah, look at that peak, just that bottom, just around $100. I mean, look, it was the perfect storm for them, really. So Meta's reason to exist, its USP, is the fact that it does targeted advertising way better than anybody else, right? There's that whole, 50% of my advertising budget is wasted, I just don't know which half. That is a targeting comment, right? And you're sitting in there in the cinema watching an advert and you're like, well, this is boring because it's not targeted at me.
I don't
right?
care.
Yeah, I don't care. And unless you're going to get rid of advertising, which is very unlikely, people are always going to want to advertise. And I would argue targeted advertising for me is better than just, washing powder adverts or whatever the case is. So targeted advertising, and that was their USP. They had this huge runway for pricing growth because pricing was very cheap on Facebook and compared to certainly TV advertising. And so that was great for big advertisers, but it was also really good for small advertisers. So if you owned a wedding dress shop in Guildford, you could, target your target market. Bish bash bosh. The problem was that Apple a couple of years ago introduced changes to app tracking that we've all seen. It was called IDFA, and what it basically said was that Facebook couldn't collect that data, and so they couldn't target you, right? And that plus subscribers and people getting a bit of fatigue of what's called blue Facebook, original Facebook,
yes,
as opposed to Instagram, meant sub numbers were coming down. And then there was also the threat of TikTok as well, right? And TikTok was, their USP was short form video, right? Previously, you'd all been scrolling through stuff and looking at stuff that your friends were doing on Facebook. This was just general entertainment in short form, right? And what Meta and what internet companies are very good at is they have fast followed or copied.
Fast forward, it's a nice word for it.
What TikTok does. So let me break it into a few bits. So the IDFA tracking changes, they have Meta, and it's taken them a couple of years, but they have managed to use AI. And they've completely re-architected their data centers with a lot more GPUs in them, and they've also used a lot of client data, so sort of first-party data, but from advertisers, to not know that it's definitely Dave Henry, but they're pretty sure it's Dave Henry or somebody like him.
Yes.
Right, and so that's brought back that USP in terms of targeted advertising. So if you speak to big advertisers, the ad agencies, which I do through my media stuff, Facebook went away as a trusted source and a must-use. And now it's back as a trusted source, right?
Is there presumably a wee bit of bleed from Twitter in terms of advertising, because it's been abandoned ship over there, hasn't it?
So yeah, market shares. Basically, what's happened is Meta was about 20%, 22% of the advertising market, digital advertising market. It went down to sort of 18, and then it started to come back into the 20s, something like that. Twitter's always been a relatively small piece of that pie. It's dominated, 44% of it is Google, right? And then you've got Amazon advertising in there as well. Twitter's actually a relatively small part, and then you've got Pinterest and Snapchat and a few others, right? So that's the pricing piece. They fast followed with, in terms of engagement and subscribers, they released Reels, right? And Reels has seen really good engagement, and they've now just started to monetize that. So that's been, really positive for them. And then they've got Threads coming as well, which I think is super interesting.
100 million users, 5 days.
Yeah, 100 million users, 5 days. It's tailed off a little bit, but they've got 2 billion people who use some form of their apps. So there's a big runway, and let's face it, Twitter have not been very good at monetizing
themselves in the foot. So.
You still on Twitter?
Yeah, regularly. It's on my news feed, but I mean, they just seem to be blowing themselves up.
Yeah.
So they've fixed the pricing piece, they've fixed the engagement piece, and then there's some interesting things that they're doing. Like we've talked about Threads, and what's interesting about Threads is they're imitating Twitter, but when you think about their advertising platform, it's giving you another way that you can look at Dave Henry. What's important is how Dave Henry engages with the Meta group, right? So you might not be a Facebook fan, but you might be an Instagram fan, but you might really like Reels. Yes. And if you're on Threads as well, that's more data, and that's all valuable. Like wherever you look turns into money.
Yeah,
for somebody, right?
Go and flog you something.
Yeah. So Reels, they weren't monetizing until the last sort of 9 months, something like that. In next year, it'll be 11% of revenues. Right. So
have they monetized?
2025, it'll be 11%.
Have they monetized WhatsApp at all?
No. So this is really interesting, and that's to my point around them being a bit of an AI winner, actually. So I talked about how they're using AI to do targeting. They've redone their advertising platform so that it's much more focused around our return on investment for advertisers. So there's AI going into that, and then WhatsApp. If you think about how you use ChatGPT, the big breakthrough with one of the big breakthroughs with ChatGPT has been the fact that you're sort of writing and engaging with it in a sort of chatty style. Think about businesses using WhatsApp as a chatbot, essentially. So there's a possibility that they can monetize WhatsApp as a chatbot for sort of consumer engagement. But Facebook's or Meta has had a very mixed success rate with enterprise tech.
Yeah. Do you remember they bought in? Wasn't it $1 billion they paid for Instagram, and people were laughing at them?
Sure. It's done it right, that.
Narratives.
Well, it's like YouTube, Google buying YouTube.
YouTube is absolutely unwatchable. I can't do over YouTube. It's absolutely unwatchable at the minute.
For DIY, as I said to you earlier, if you give me YouTube and Amazon.com, I'm dangerous when it comes to DIY.
Yeah, if you give me a couple of the Yellow Pages and a number for a decent tradesman, I'm unstoppable. Ben, that's great. Thank you so much. We've come up on time. Have we about sort of 3/4 of an hour? Thank you so much. That was really interesting. Thank you for joining us, folks. Episode 12. We'll be back next week again with Husey, I believe.
He's back from Centre Parks, is he?
Yeah, he's back from Centre Parks.
UK Centre Parks.
Holland.
It's £1,000 cheaper.
well, that's what he said.
Yeah.
Well, there you go. He's got £1,000 in his pocket and he's back from Rotterdam.
Hack for all the viewers out there.
Join us next week. Thank you, Ben.
Thanks so much.
Catch you soon.